the American Civil Liberties Union is suing Morgan Stanley for the predatory loans that were made by the New Century Financial Corporation, which was a mortgage originator, because of the investment that the bank lent billions of dollars to New Century. It is now, of course, in bankruptcy, and it pressured New Century to make these crappy loans because, of course, they needed essentially product to put into these securitized financial instruments that they could turn around and sell. And these loans that New Century made were basically, in many cases, what is known as liar loans, and specifically targeted at low-income African-American families. And the ACLU has filed suit claiming that Morgan Stanley violated the Fair Housing Act and the Equal Credit Opportunity Act in actually targeting people that they anticipated, this would be New Century, anticipated would have a high degree of financial illiteracy, knowing all the while that these loans were crappy loans, and then turning them around and selling them in these big packages as investment opportunities. Robbie McCoy, one of the 5 named plaintiffs in the lawsuit, took out a loan from New Century in 2006 with an adjustable rate starting at 12.14%. Now, I can tell you, I got a mortgage in 2005 at 6.25. So they target people that they know have bad credit. They put them in a subprime loan at twice the going rate of any other loans, making it an adjustable rate, which probably means actually that it's even more than twice the going rate, because mine was a 30-year fixed. The rate could not fall below 10.75%. It came with excessive fees and costs, according to the suit. McCoy was a single mother. She couldn't afford the payments, but the broker told her to lie on her income to get a house. She said, having a house was a way to keep my kids grounded, she said. She's a Detroit citizen. And so what you have here is you have a mortgage originator pressured by Morgan Stanley, which has invested a ton of cash into this company, telling them basically, like, look, we want product. Give us product. We don't care what these mortgages look like. The mortgage originator goes out and finds the most financially illiterate, most desperate people in the country, sells them these loans, tells them, hey, I'm a professional. Don't worry about putting your income down. Don't worry about this. 50% of your income, that's the average. To pay for a house, that's the average. Now remember, Morgan Stanley was pressured by Massachusetts Attorney General Martha Coakley for its packaging of New Century mortgage loans. In 2010, the bank agreed, under threat of suit, to pay $102 million to close an investigation by the Attorney General of Massachusetts. At that time, Coakley said the bank ignored warning signs about the quality of New Century's loans and tried to court the lender's business by lowering its loan standards. Look, these people are professionals, theoretically. That's what banks do. That's why they have loan officers. They have a fiduciary responsibility, not just to their shareholders as a bank, but also to the extent that they are federally insured. And certainly to the extent that they are backstopped by the federal government, whether it's the Fed opens up the discount window at 0% interest, or they get bailouts from Treasury. The subprime loans cited in the suit were made from 2004 to 2007. New Century, one of the country's most prolific subprime lenders, went bankrupt in 2007. New Century was responsible for the greatest share of loans in foreclosure in the 10 metropolitan areas blighted by the highest foreclosure rates. What a coincidence. A former employee who testified in a separate civil suit against Morgan Stanley said that the bank officials knowingly bought loans in which borrowers' debt levels were more than 50% of their total income. The bank, according to one former employee, typically did not require New Century to conduct a second appraisal of homes, fearing that the second look would result in lower assessment and prevent the loans from being securitized. In other words, all of the internal backstop measures, all of the internal regulations to prevent these things from happening were essentially waived so that they could happen. African Americans living in Detroit area were 70% more likely to wind up with a subprime loan than were white borrowers with similar financial characteristics. This according to an analysis contained in the lawsuit of New Century loans made between 2004 and 2006. So they were preying on African American communities because they, I suspect, believed that there was a wider financial illiteracy than there were in white communities with the same financial background. Financial background in terms of what their income was, what their debt levels were. And I think the theory was, if we go into these blighted areas, much less likely that somebody has a cousin or a relative or a friend who lives across town who can say, hey, wait a second, this doesn't seem right. The Justice Department has accused two major banks of discriminating against black and Hispanic customers. A settlement in one case was announced in July when Wells Fargo agreed to pay $175 million to settle claims that the bank steered roughly 34,000 minority customers into subprime mortgages, even though they could have qualified for mortgages with lower fees and less risks. For Miss McCoy, the $79,000 loan that allowed her to buy a home in 2006 quickly turned into an albatross. She struggled to pay the monthly amount, which at the time consumed more than half of her monthly income. She's got 3 kids. She's a single parent. She is 4 kids, trying to keep them off the street. Figures the only way to do this is to buy a home. Professionals sit her down and tell her, don't worry. This is what happens all the time. Don't worry about a thing. Suck more fees out of her. Give her an inflated rate so that they get more fees out of it. And everybody along the line makes money. And in the end, she just gets screwed.